I don't know about you, but I have a tendency to see things in black and white. I'm a very narrow-minded and stubborn person, which are horrible traits to have as a trader. And because of this, I've been losing money over the last few months. During June, July, and August, I continued to lose money as the stock market kept going up, but in September, I changed things around. And so far this month, I've made over $3,000, making for my best month ever. And my secret is hedging. So in this video, I'm going to be teaching you all about hedging, why hedging is important, and how to hedge your options positions. First, I need to explain what is hedging. Simply put, hedging is diversifying your options portfolio. And I'm sure you've heard the old saying, don't put all of your eggs in one basket, but you probably think this is just for long-term investments. People telling you that you shouldn't buy into Tesla alone, instead you should buy into the S&P 500, which I actually think is over diversification, and diversifying your options portfolio is just as important. Because like I said, I've been losing money over the last few months because the stock market continued to go up and I kept betting against it. But if I had a couple of bullish plays here and there, I would have been able to save some of the losses that I took. But you don't want to overdo it whenever it comes to hedging your options positions. Like I said with the S&P 500, that's over diversifying. So you don't want to have 500 different options plays open because then you're going to be losing your freaking mind.
And it's gone.
You have to focus on all these different trades and it can get extremely stressful. I've been there. I've been sticking with between 3 and 5 trades every single week. And if I go above that, then my stress levels go up and it's not a fun time. But since I've narrowed myself down to 3 to 5 trades a week, I've been more successful. And the way that I've been diversifying my positions is by having different directional assumptions. So I'm assuming different stocks will move in different ways. For example, right now, I'm betting on Apple coming down because it's extremely hot in terms of relative strength index, but I'm betting on Costco going up by the end of this week because they have their earnings report coming up, and because of the high food inflation and the seasonality of this quarter, they should post better results than what Wall Street expects. So I'm betting on Apple going down and I'm betting on Costco going up. So this can allow me to make money in both directions. Whereas if I just had that Apple position, I would only be able to make money on Apple in the stock market coming down. But since I have 2 separate positions, one bullish and one bearish, this is going to buffer the volatility of my portfolio. So again, this is a lot less stressful whenever you're hedging your positions. And there's other ways that you can diversify your options positions as well. It doesn't have to be all about direction. It can also be in terms of your expiration date. So instead of just trading weekly options, sometimes it's nice to add in some monthly options or even some leaps. So you can diversify in terms of the amount of time your option has until expiration, like I did with SPY this week. I'm betting on the markets rallying ahead of the Fed meeting this week on Wednesday, and I have a SPY iron butterfly assuming the markets are going to be at 392 right before the Fed meeting. But there's also the chance that the Fed meeting could go completely south, where the Fed members decide to raise more than the 75 basis point expectations. And if the Statement of Economic Projections, or the SEP, comes out to where rates are going to be a lot higher than what the markets are expecting, this could end up dropping the markets in a really big way. So again, I'm planning to close the bullish trade right before the Fed meeting, and I'm planning to hold the bearish trade for after the Fed meeting in case things go south. That way I can make money on the market going up today and make money on the market coming down next week. So this is how you can diversify in terms of time. I have today as my expiration date on Wednesday, and then I have an expiration date for next Friday. So I give myself plenty of time for SPY to come down below my $378 strike price. It doesn't have to get there immediately. Instead, I'm allowing the Fed meeting to bake for a little bit longer in case the markets react differently after the Fed meeting versus before the Fed meeting. So that's diversifying in terms of time. And there is one more way that you can diversify your options positions. And this is going to be to trade with different kinds of equities. You could trade just tech, but if you're trading just tech, it's not going to trade like every other stock would. Now, the stock market breadth, or how stocks trade in relation to one another, has been incredible. We haven't seen this kind of stock market breadth in a very long time. But that's not to say that some industries can't do better than other industries, depending on how things are changing. Because as interest rates go up, Tech stocks are going to come down because it costs the tech companies more money to grow their company by taking out loans at higher interest rates. Whereas right now, grocery stores are doing extremely well because of the high food inflation that we're experiencing. So diversifying into different sectors throughout the stock market is equally as important. And these are just 3 ways that you can diversify your options positions. There's other ways that you can diversify, like through volatility, expecting more volatility on one trade or expecting less volatility on another trade by opening an iron condor. And another way to diversify your options positions is by taking on different sizes for different trades, because not every trade is made the same. And I do this based on how confident I am in the trade. So I have a grading score to where if I'm most confident in a trade, then it's going to get an A score. If I'm less confident in the trade, it's going to get a B score. And if I'm least confident in the trade, it's going to get a C score. And I use this to allocate my risk accordingly. For an A score trade, or the ones that I'm the most confident in, I'm usually putting up $1,500 or more in risk to open that trade. And my options balance is around $10,000. So this is about 15% of my portfolio that I'm putting down on my most confident trade.
Does this look dangerous?
And if I'm less confident in the trade, it's going to get a B score. And for B score trades, I'm usually putting down anywhere between $800 to $1,200 in risk. So with a B score, I'm only risking 8 to 12% of my account versus an A score up to 20% of my portfolio. And finally, for C scores, or the ones that I'm the least confident in, I'm usually only putting down anywhere between $500 for that trade or up to $800 in that trade. So between 5 to 8% of my portfolio versus the B score 10 to 12%. So today, going into the Fed meeting, it seemed like a toss-up between the bears and the bulls and how the markets would react to the Fed meeting. So I decreased my position size on the iron butterfly that I was bullish on from what was $800 in risk down to $500 in risk. And I had a bearish trade with a put debit spread, also risking $500, so I had a 50-50 split between my main trade and my hedge. But if I was more confident in the market going up, I would have kept the position size relatively the same or even increased it going into the event. So that's just another way that you can diversify your options positions, and so far all of these hedging techniques have worked out really well for me, especially compared to the last few months of trading. I kept losing money because I kept betting on every single stock coming down while the stock market continued to go up, but now that I've started to diversify my positions, I've made over $3,000 so far this month. This has been my best month yet, and I attribute a lot of this to hedging. So hopefully you found this video useful, and hopefully you can make some profits by starting to hedge your options portfolio. Thanks for making it all the way to the end, and thank you to all my patrons for their support. And as always, remember to stay positive, stay green. I'll catch you in the next one. Bye, guys.